Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook and your host for about the next 15 minutes here on Options Guide TV. We are taping Options Guide TV. It is Tuesday, December 30th. The markets are open and rocking and rolling. It's about 12:15. We're going to do a quick little review of the trade that we set up on Monday. We did a 2-day trade, a 0 DTE and a half trade, if you will, in that we put it on Monday just before the noon Eastern hour. We did we picked an expiration that is the 30th, which is today, Tuesday. We saw the markets continue on down. Basically, more than anything, they just kind of stabilized and really didn't go anywhere. So based off of where the markets are at, this trade is looking pretty solid. We put it together with the S&P 500 index right at 6,900. And right now, using the derived value, it's saying that we're at 6,897. So we're very close to where we put the trade on, which is a goal of a butterfly. We didn't mind if it went down. We used puts. We leaned to the downside on our trade. So in other words, we were fine if the markets went down, if the markets stayed where they're at, or if they just drifted a little bit higher. So right now, we're right in the sweet spot of this trade. So what would you do? Well, we always have a rule that we want to close them out before 2 o'clock. If the market continued to drift south of this number right here, we're okay on the trade. And so we could hang around to see where we land on our trade. If it drifts lower, if it drifts higher, or it stays where it's at, we want to stick to our rule and get out at 2 o'clock. If not a little bit sooner, we are now profitable on the trade, so we could take our profit at any point in time on our 2-day trade that we put on. So I'm going to run to the what if calculator, and I'll talk a little bit about where the market is at and what we want to happen. So when we put the trade together, the market was right about here, right about where my crosshairs are at. Don't pay attention to the profit and loss, but that's about where we were at. The market has now drifted to here and below, about 3 points below where it was yesterday. So ideally, if we go out right at that peak, right at that precipice of our butterfly, then that's the maximum that we could make on the trade. We put the trade on for about $3. That's what my screen grab was $3. So I know it was dancing around that number. And the maximum that I could trade for is $10. That means that you could make $7. Now, that would only happen if we stopped right at 6,900. And I know that we've had a couple of trades, in particular in gold, that stopped right at our strike. But that is obviously not a goal that you want to try to ascertain. You just want to get your profit on these shorter term trades, take advantage of the time premium and get out. So right now we see it's trading, well, 435. It was just at 450. We'll call it 440. Let's go right in the middle. We put it on for $3, take it off for $4.40. Nothing wrong with that. Go ahead, exit the trade. If you want to stick around, it's fine. What I would do is, if it keeps drifting lower, the maximum we could make, it says 75 here because it's grabbing this price, but the maximum we could make on the downside would be $200. So if the market did drift lower, we put it on for $3. It's got to trade for $5 at expiration. That means we would be up $2. So we're fine if the market drifts this way. But if we see it just start bouncing back, getting above the 6,900 level, we want to get out of the trade right away, almost instantly, if you will. As a matter of fact, you could put an alert in, and if it hits 69.01, I'd probably close the trade right at this, because this is where our risk is, right? It starts coming back this way, it gets up to 69.10, then the trade's a loser. So we want to get out and make sure we capture it. We don't mind if it goes south, but we're not happy if it starts going north, and we just want to get out and capture our gains. We had put together a solid trade. Markets didn't do much after we put the trade on, which usually makes sense going into the Christmas holiday. As a matter of fact, I was expecting to get a little bullish, but I think that the Santa Claus rally gets talked about so much now that a lot of people lean into the rally, and what was good is no longer good anymore. Like I heard one pundit on a financial station over the month of December say that 70% of the time, going back over the years between Christmas and New Year's, the market has a positive reaction. In other words, the market is up, and usually a significant amount. So I think that it's been talked about too much that now the reverse has happened. That's usually the case with the markets. Whenever it seems too good to be true, eventually it isn't. Okay, gold. We saw gold. We put together our gold trade. Let me throw this in the what if calculator. And I'm just going to talk about it for a second. You should have been out of this trade when actually on Friday. I did not have a show on Friday because I was traveling and it is the holidays. And but the markets were right where we wanted them on gold, and that would have been your opportunity to close them. But now we see the markets actually tanked over the weekend. A lot of metals gotten beaten up, and gold was one of them that went around with it. We still want the market to get back to 408 level. This is the trade, and I guess we can send it. We could go over here, type in GLD, and we could show it this way. But the market has rebounded at least. So if you did not get out, you still got an opportunity here. Send to the what if 113. We put it on for 180, $1. No, actually 190. Yeah, 193 to be exact. And so we are still down on the trade. But if we start getting above this 403 level right here, trying to make there it is. Once we get above that level, this trade looks good again. So at this point in time, we should get out. We talked about an adjustment on Monday's show if you want to go back and review the adjustment. But, we're picking a particular time when we do the show, and the adjustment is interesting if you want to learn how to adjust them, but it kind of moved on. We kind of missed out on that opportunity to make that adjustment, but it is an interesting adjustment that you can do to butterflies if they go against you. So nice to see it come back, probably already out of the trade, and it is what it is. So by the time we come back, it'll be the new year. So we'll see you in 2026 for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.